Hey everybody, welcome back to the Statistical Trader YouTube channel. Diamond with you here, and today I want to share with you a principle that helps reduce drawdown periods and drawdown sizes in a very systematic way. A principle that is also not very commonly known in the retail trading world. So let's go. Okay, so this thing is called trading the P&L curve, and as the name states, we're gonna use the approach that we use in trading. We're gonna try to predict what happens with our P&L curve ahead of time, before it happens. And we can do that by applying indicators, patterns, or whatever else we find useful on our P&L curve. So I'm gonna explain a little bit how this works, and then I'm gonna share with you an actual example of how I use it on one of my strategies. So the idea here is to either start or stop trading your strategy, or in the case of automation, start or basically enable or disable your trading algorithm when certain things happen with your P&L curve. So what we want to do is we want to constantly observe our P&L curve, how it changes, and then apply certain analysis tools to that curve to help predict the movement of the curve itself in the future. And once we get a signal to disable our trading, we're going to stop trading, but we will keep on monitoring our P&L curve without trading by constantly running the backtests or adding in simulated trades to this P&L curve that we have. And we're going to see how it changes in the future until we get the signal to enable our strategy again. So now let's go to an actual example. I'm going to share with you my screen. You're going to see one P&L curve of my strategies, and I'm going to show you how I apply this in practice. Okay, so this is a curve of a cryptocurrency trading algorithm, and this has been active for almost 2 years now. This is a trend following algorithm. So as you can see, we have these huge run-ups and then drawdown with stagnation, and another run-up and drawdown and stagnation again. So what we aim to do here is we aim to eliminate or shorten these stagnation periods by simply turning our strategy off. And what that does, it frees up our equity to be used on maybe other algorithms, or just to not sit and pay the commissions to brokers, especially if you're using margin trading, especially on cryptocurrencies, which the fees on that are like crazy high. So we just aim to remove that. I do this for this particular algorithm in a very simple way. So I apply an exponential moving average to my P&L curve, and when the P&L curve goes under the EMA, I stop trading, but I keep monitoring the algorithm as it performs, and as it goes back up above the P&L curve, I enable the algorithm again. So let's see how this looks. So I'm gonna add an indicator here, exponential moving average. I use 12 period EMA, and this is how it looks. So basically what you can do here, it depends on an algorithm. Some algorithms you might want to use certain strategies on the curve. So for example, the trend following algorithms, usually a good idea is to disable the algorithm when it diverges from the moving average or from the mean of the P&L curve by a certain amount, which would be a good case to use here. So let's say it diverges from the EMA by 2 average true ranges or something. We disable the algorithm, because that's how trend following works, right? We have a run up, that's where we get the divergence, and we stop at the top or near the top, and we wait for it to kind of stabilize, and then we can adapt something else where, let's say, crossing above the EMA, like I do in this case, to re-enable the strategy. If you're trading, for example, mean reversion strategies, you might want to use something different. So definitely feel free to explore this. One thing I would probably give you as a piece of advice is to not go overboard with indicators that you use here, and use more simple indicators such as moving averages or maybe directional indices or something like that. Don't go very sophisticated, because as we all know, the indicators, they're kind of self-fulfilling. It's in the eye of the beholder. You can tweak the parameters there, and that improves the curve fitting, and it's not as trustworthy as you're going into the out of sample data. So stick to something simple indicators or patterns. Patterns usually work the best. Okay, so say we are starting our algorithm to trade somewhere here. So basically what's going to happen is at the end of each trading day, each trading week, really depends on the algorithm. What I used to do is I would used to do it on Sundays at the end of each trading week, or maybe as you close a trade, you can do that as well. I would monitor how the P&L curve changes, and basically how it looks is like this, so we started here, but then I go into the future. The following week, these data points keep appearing. The chart is still, as you can see, above the EMA, so we're still trading, and boom, here it crosses down under. So this would be a signal for me to stop trading this algorithm. So I'm going to turn it off, and then I'm gonna keep on monitoring it by, in this case, by running backtests, because the algorithm is done in a way where a backtest matches the algorithm 100%. So I'm just gonna keep on running the backtests and see as this chart evolves. So as we can see, it's still below the EMA. I won't do anything. Still below the EMA, nothing, and there we go. So this is where it crosses back above the EMA. So in this case, I'm going to enable the algorithm here. So what we achieved by doing this is we actually eliminated this whole movement from the P&L. So now the actual P&L is not going to look like this. It's going to look like we stopped here, and now we're starting trading again from here. Now obviously we lost a bit of a run up, but that doesn't matter because the period that we have the money, that's more important to us. So we re-enable our strategy here and we continue trading until it's again above the EMA. So we have all this move, and bam, again, we stop trading here. I disable the strategy and we wait for it to come back above. So this whole move, it's still below. We wait, and we still wait. So that's actually a long period of time. And here, this is the move that puts us back up above again. So we start trading again here. Now I know this is a huge run up we lost, but then also just look at the drawdown that we eliminated as well. Basically this whole drawdown period, these are gone from our P&L. So we start trading here. And since it's obviously a trend following algorithm, we hope that this will keep on running up, make new highs. And we just let it run, and it stops here again. Now obviously for cryptos, it's not been a good period to trade this past year, but that's where we are at right now. The algorithm's off, but basically we are protecting ourselves against these moves down, and that's more important for me than losing this rally up here. So this is what you can do. You can obviously make this more sophisticated based on what you like, based on what your algorithm is, your analysis tools that you're used to, whatever works for you. I am sure that there are ways for me to actually catch up on these rallies up that I lost with this approach that I'm taking, but I just wanted to stick to something very simple, very fundamental, just because when I'm actually getting these rallies up in this algorithm, they make up for all of these drawdown periods. The main purpose for me is to not have my money frozen in positions that are losing capital at the moment. So that's what we achieve here, and I'm very happy with it. And I just wanted to share this with you, just to spark some inspiration and maybe give you an idea for creative experimentation here, where you can hopefully improve your trading as well. So thank you so much for watching. I hope you enjoyed this video. I hope this was new to you. If you like this content, please give me a like. I'm a growing channel, so that's definitely going to help me out. As usual, if you want to see more content like this, feel free to subscribe, and see you in the next video.